As I told you earlier, we are now on the home stretch of this course. We've got two topics to go. Topic 13 deals with uncollectible accounts. I'll talk more about that in a few moments. And 14 deals with cost of goods sold once again and financial statements once again. So we're going to begin with the end in mind here. We're going to look at a couple financial statements on your screen. You see an income statement on the left, balance sheet on the right. They are much more detailed than the ones you had way back in September. If you remember, we started the course with financial statements that were pretty simple compared to these. I want to take a look at what is on these two statements, and that will introduce topics 13 and 14 for you. Topic 13 deals with something called uncollectible accounts. Anytime you have sales, and anytime particularly you have sales on account, you have to deal with customers who unfortunately don't pay what they owe to us. We are assuming that the ABC Bookstore LLC provides its own credit to customers. So we're not talking about credit cards here. We'll talk a little bit more about that in another few days, but right now we will assume that all the credit that the ABC Bookstore gives deals with their own credit system, so that if a customer does not pay back what they owe to the ABC Bookstore, obviously the business stands to lose. So it has to be able to handle that. And in the real world, businesses know that this is always going to be the case to some extent, and they have to allow for that. So you'll find as you go through accounting that there's more and more educated guessing going on, is the best way to put it. You can't always determine precisely what will happen in the future, so sometimes we need to make an educated guess. So we will have to assume, for example, that some people won't pay us back, and we have to do our best work at estimating how much that will be and indicating that on the financial statements, as we will see. First of all, let's look at one of the statements, the balance sheet on the right. A couple things here that you did not have on the early balance sheets way back last fall. Under assets on the left, we have current assets and we have plant assets. We talked about the difference a little earlier, I think, to some extent. Basically, plant assets are the large ticket items, the expensive items that we own that will wear out over time. So we have in this business two of them, office machines and a truck. Both of them will depreciate over time, and we've talked about how that works, and we talked about an account called accumulated depreciation. Once again, I want to show you that this is indicated. Let me highlight it here so you can see it easier. It will be shown on the balance sheet because the owners, and again, this is a limited liability company and we have stockholders. There may be just a few of them. They may be family members or they may be some acquaintances that got together and started a business, but they have incorporated and they are actually owners of the business and they turn themselves stockholders. And as owners, they will want as much information as they can get. So this will show us that we have office machines in our business valued at $1,200. The $1,200 indicates the amount that we paid for the office machines at the beginning. Accumulated depreciation, as you remember, hopefully, indicates the amount of money that we estimate these office machines have worn out to this point. So up till now, these office machines have depreciated by an amount of $500. And when you subtract 500 from 1200, we have the net value right now of the office machines. We know at one time they were valued at 1200 when we bought them. Now they're valued only at 700. Same way with the truck. Truck was purchased at 60,000. Accumulated depreciation is shown here, and with the net value is 52,500. So that's something we've had in the past, and now that would be shown under a heading plant assets. Sometimes you'll hear the term book value, and in a sense, This is what our books show as the value of our office machines. The net value, the book value is 700. The book value of our truck now at this time on April 30th, 2020 is 52,500. Now, let's go over to the income statement. Let's look at the revenue section. If you remember back early on when we looked at income statements, there were only two parts. We had revenue, we had expenses. You subtracted expenses from revenue and you got net income. Now we have a third section. Not only do we have revenue, but we also have cost of goods sold. And we'll look at that a little bit today, but more in detail in topic 14. And then we have our expenses. All three are involved in determining the bottom line, way down here, of net income. Let's go back up to our revenue section. We now have a division of sales. We have sales for cash, 5,000. We have sales on account, 150,000. So we see that the revenue is of two kinds. Most of it is sold on account. Total sales then is simply an addition of the two. Then we want to show, as we looked at in previous topic, we want to look at this section that indicates not only the total sales, but the sales discounts and returns and allowances. So a discount, again, indicates money that we have discounted to a customer. So we have deducted a percentage typically from what a customer owes us, and that may be a number of different customers, but those discounts add up to 75.63. So that's a negative number. That has to be subtracted, as we'll see. Also, sales, returns, and allowances. This is a little more critical to the business because we don't want to get this number too high. This indicates the amount of money that customers return to us. They return merchandise, and we gave them money back, or we gave them credit, or an allowance. All of those add up to 1,550. When you add these two minus numbers, the negative numbers, come to 9,113, and that is subtracted from our total sales. So we have net sales of 145,887. So it makes sense, hopefully, to you now that these are negative numbers, and it would help for the owners to see those numbers, not only the total sales, but also they would want to know how much we have been giving out in discounts. Maybe it's too high. Maybe we want to lower that a bit. Maybe we should increase it. It's important to have that information, though. And also returns and allowances. We often will compare income statements from previous months, and we want to see if this number of returns and allowances is going up. That would be a concern. So that's something that we've had before. Now, something more recent that you just had deals with the opposite of sales returns and allowances and sales discounts. It deals with purchases. So let's look at this little section under the heading cost of goods sold. First of all, we have purchases, and we have two negative or minus numbers indicating net purchases. So this tells the owners that we made purchases of merchandise. And again, this is not purchases of supplies or that type of thing. It's purchases of merchandise of 40,870. Then we deducted. We got discounts of 1935, and we returned some things, or we got allowances, and that added up to 500. So these two are subtracted from the total purchases indicated with the 40,870. When you subtract these two numbers, you'll get net purchases of 38,435. So that's something that we just talked about just recently. Now let's expand just a bit on this section called cost of goods sold. The new thing that we will look at in topic 14 will be this section. We will have on our income statement merchandise inventory as of April 1, 2020. So remember, this income statement is for the month of April. So on April 1, the beginning of the income the accounting period, we had merchandise inventory total 61,000. Then we go through this mathematical computation. We take purchases, subtract the discounts and the returns and allowances. We get net purchases, and we add that to what we had at the beginning. We had 61,000 at the beginning. We bought another 38,000 net purchases, giving us something we call total cost available for sale. So that's what we could have sold. But we didn't sell everything. We took an inventory at the end of the accounting period. So less merchandise inventory on April 30th. So at the end of the accounting period, we had some left over. And that's still on our shelves. We haven't sold that yet. We have $64,000, a little more than that, available for sale. It's still on our shelves. We subtract that from the $99,435, and that will give us the cost of goods sold. And again, we're not responsible, you're not responsible for all of this cost of goods sold section yet, but we will be talking about it in topic 14. So once we finally come up with this cost of goods sold, we then subtract it from the net sales way up here, and we get gross profit. Then we have all these typical expenses, we subtract, and we get the net income. So these are the new things on our statements based on what we've already learned, at least part of it that we've already learned with the depreciation and the discounts, both sales and purchases. Now, one more thing I want to show you on the balance sheet. Back up here in the balance sheet, this will refer to what we cover in topic 13, the one we're starting today. If we look up here, we see accounts receivable and something called allowance for uncollectible accounts. This little section that I've just highlighted. This will get into how we account for estimated losses. Now, we don't always know when this is going to be. We don't know how much this is going to be. We don't know when a account receivable from a customer will turn into a bad debt. Unfortunately, sometimes it does. There's a way to compute this based on history of the business and a number of other factors that we'll look at in topic 13. But this is what it ends up looking like, kind of like we did with the depreciation and the discounts with sales and the discounts with purchases. It's a situation where we show the total here, accounts receivable. So we have a total in our accounts receivable of all the customers. All of our customers owe us a total of $49,800. Then we have something called allowance for uncollectible accounts. This will be a minus, a deduction. We will subtract that. And we somehow came up with $1,500. It's based, as I said, on a number of factors that we will look at in topic 13, but is shown on the balance sheet so that we expect to lose $1,500, mainly based on past history and perhaps the kind of customers that we deal with, but we expect to lose some of the money. So realistically, we're not going to collect every penny. We expect that some of it will become bad debts, and when you subtract the $1,500 from the $49,800, the net amount that we expect that we will actually get is somewhere in the area of $48,300. So that will impact the total current assets. So instead of $49,800, we have a lower number that will make our current assets a little bit lower. And then we add the current assets plus our plant assets, and then we get total assets at the bottom. Hopefully a realistic amount of money. So those are the new parts of our two financial statements that we will take a look at. At this point, I'd like you to go back and answer a couple questions based on this video. And as I've told you many times, these videos are always available for you to review. And this is an important one for both of these topics, 13 and 14. So you might want to review it again.